Did you know that historically the S&P 500 has been on the rise, growing at an average rate of 10% per year? However, our economy has faced some challenges in recent times, and a lot of people are curious if it's still a good investment option. So, what can we expect from the S&P 500 in the next 5 to 10 years? The Standard & Poor's 500, or S&P 500 for short, started in 1957 as a way to keep tabs on 500 big companies listed on the New York Stock Exchange and the Nasdaq. These companies were chosen to mirror the overall makeup of the US economy, so when you invest in the S&P 500, you're essentially buying a small portion of the 500 largest American companies based on their market value. The great thing about the S&P 500 index and ETFs is that you don't have to constantly research every company and worry about selling if one starts performing poorly. If a company consistently underperforms, it gets removed from the index and replaced by a successful one. Therefore, you can benefit from this without even knowing about the new company because you're invested in the S&P 500. The companies in the S&P 500 will change a lot over the next 20 years. That's one of the main reasons investing in it is a great choice. You'll always have a stake in the top 500 companies based on their market value. For instance, in 2000, the top 10 companies included General Electric, Intel, Cisco, Walmart, and AT&T. But in 2023, the top 10 companies are completely different, with Apple, Amazon, Nvidia, Google, and Meta taking the lead. On a side note, many people believe they can outsmart the market or have found a brilliant strategy. Their argument goes like this: since the S&P 500 is market cap weighted, it heavily focuses on the top 10 or top 20 companies that make up a significant portion of the index. So instead of investing in the entire S&P 500, why not simply invest in those top 20 companies? The issue is that if you only invest in the top 20 companies, you might outperform the S&P 500 in the short term, maybe this year or next. However, the problem lies in maintaining consistent performance over the long term. As I mentioned earlier, if you had invested in only 10 specific companies back in 2000 instead of the S&P 500, you would likely still have those 10 companies today. But here's the catch: those companies wouldn't include major players like Apple, Amazon, or Nvidia. You would miss out on these significant companies if you solely focused on the largest ones at that time. So we understand that owning the S&P 500 is a smart move because it has historically shown an average annual growth of 10%. But what about the future? Currently, there's a lot going on with inflation going wild, banks facing collapse, and unemployment rates going up. It feels like there's bad news every day, like other countries refusing to use the US dollar and the constant threat of attacks or invasions. People are saying that the climate we're experiencing now is unlike anything we've seen before, so it's unlikely that these investments will perform well. Well, let's take a look. Back in 2008, when the financial crisis and Great Recession hit, the S&P 500 fell a whopping 56.8% from October 2007 to March 2009. But here's the exciting part: it managed to recover all of its losses. Fast forward to March 2020 when the coronavirus pandemic struck, causing a global recession and sending the equity markets into a tailspin. The S&P 500 took a dive of 34%. However, it didn't stay down for long. It started to bounce back in the second half of 2020 and reached record highs in 2021. Times are tough right now, and they might continue to be challenging for the rest of this year and maybe even part of next year. But here's the thing, it's not exactly a new situation. The market has experienced corrections before and has managed to handle them just fine. It's like a roller coaster ride, you know? It goes up and down, but eventually it finds its way back up again. It's super handy because you can apply it to any kind of investment like ETFs or even real estate. This rule is a simple way to figure out how long it'll take for your investment to double in value based on its rate of return. Here's how it works. You take the number 72 and divide it by the expected rate of return. For example, let's say we can expect an average of 10% for the S&P 500. When we do the math, 72 divided by 10, we get 7.2. What does that mean? It means that if you have a 10% appreciation, it should take around 7.2 years for your money to double. Now let's check if that's really true. We'll look at the prices of the S&P 500 in the past and see what happened. And if we were to just choose one year, people might accuse us of selecting the best year on purpose. So here's what we're gonna do. We'll randomly select 3 consecutive years, calculate their average, and then pick something 7 years later and calculate its average too. Let's see what happened between 1985 and 1987. The average price of the S&P 500 during that time was $236.74. From 1993 to 1995, the average price was $484.58. Let's check out another group, maybe a more recent one. Between 2011 and 2013, the average price was $1,430.35, while from 2018 to 2020, it was $2,959.14. Remember, 2020 was when the coronavirus hit and the market went crazy, so on average, the price more than doubled. Now with the current data we have, where do experts think the S&P 500 will be in 2030? Based on the average of the past 3 years, which is around $4,134, they can confidently say that they expect the S&P 500 price to be over $8,000 in 2030 or around that time. Now, most of you are probably invested in an ETF that follows the S&P 500, like SPY or VOO. Regarding the price, let's keep it simple. VOO is currently priced at $378.66, and experts expect it to surpass $700 by 2030. ETFs and individual stocks sometimes split their shares to make them more affordable for people, so it may not reach the exact $700 price, but the value of the ETF at that time will be equivalent to $700 in today's money. Experts genuinely believe in these numbers and expect them to double within that time frame, as it has consistently been done since around 1957. However, experts also anticipate some market turbulence by the end of this year, with a potential 20% drop. Now, a lot of people have their current top choices when it comes to investments: VOO, SCHD, and QQQM. These are the ETFs that many investors are favoring at the moment. Approximately 75 to 80% of their available investment funds are allocated towards these ETFs. As for the remaining 20% to 25% of their money, experts suggest putting it into a high-yield savings account instead of investing it regularly every 2 weeks. This way, you can earn some interest in it. At the end of the year, if the market has experienced a significant drop, experts also suggest investing all of that money into the market. However, even if the prices haven't dropped, it's still good to invest the entire amount, even if the prices are much higher than they are today. So, do you think it's best to invest in the S&P 500 and other similar indices now? Share your thoughts with us in the comment section down below. And that's it for this video. Don't forget to express your gratitude by clicking on the like button, following our channel, and turning on notifications to stay updated and won't miss any of our future posts. See you next time.